All right, we're continuing with corporations, and we'll hopefully be able to wrap it up in this section of the video. We got down to slide 186, and we were talking about what I call nuts and bolts of the corporation. We looked at debt versus equity, and we got into shares. We talked about how there's shares in a corporation, and then some people can hold common voting shares, and then other people can hold preferred shares, so that they get a higher investment, but they don't have a say in the running of the company. Investors like that, okay, because they invest in lots of companies and they don't want to be involved in the operations. They just want a return on their investment. There are two terms that you have to know. One is the authorized capital of a company, and the other is the issued and paid up capital. Authorized capital is the number of shares the company has to play with. If you go to a lawyer and you say, I need a company just to give myself limited liability, the odds are the lawyer will probably incorporate a company and give you the standard shares, 10,000 common shares. Those are voting shares. And then you issue some of those shares to either just yourself or to yourself and the other people involved in the corporation. If there are two people, you probably get 100 shares each, and then you have equal voting rights. If there's three people, 100 shares each, and then you've got the possibility of two voting one way and one voting the other, and so on. And so you would have authorized capital of 10,000 shares. That would be the shares that the company has to play with. In other words, to issue to people who want to be involved. The issued and paid up capital are the only shares that can be voted. So in my example where there are two people and they each hold 100 shares, that's 200 shares of the 10,000, but that means that the company has 9,800 shares. It's a separate legal entity holding those shares. Can it outvote you? No, because the only shares that can be voted are the issued and paid up shares, okay? So in other words, I can give you a share and you can agree to pay for that later on. Until you paid for it, you cannot use those shares. You cannot vote them. Okay, three people, 300. The authorized capital is now 9,700 left, and the issued and paid up capital, 300. You can change the authorized capital by having Class A common voting shares and Class B common voting shares, and you can have Class A or Class C preferred shares and Class D preferred shares. When would you do that? Well, I start a corporation, let's say, and I am the sole shareholder. I'm the sole director and sole officer, i.e. the president. I give myself 100 shares. That means that 100% of the profit can come to me in the way of dividends. Well, maybe I don't want to take it all as dividends. Maybe I'd like to give some to my spouse, because that way she's in a lower income tax bracket and she'll be able to save on taxes. Well, okay, I have Class A, or common shares. I'd have to give her some common shares, and then she's involved in the company. So what I would do is I would take Class A common voting shares, and she would take Class B common voting shares. B would not non-voting shares. Okay, so she's not involved in the company, but I can declare dividends on Class A shares and on Class B shares, and she gets some money. She's in a lower income tax bracket, and bingo, you're better off. Preferred shares don't get to vote, and they would generally have some priority to the dividends. Okay, so preferred shares means they get priority to the dividends and priority to return on capital, which means if the shares are sold back to the corporation, then they get their money first. So you're winding up the company. It's been successful. There's $30,000 in the bank, and the preferred shareholders are entitled to a preferential amount based on some percentage. So they may get 28,000 of that, and you only get 2,000 for your shares. So that's how that works. Slide 187 is a continuation of the nuts and bolts, and has certain terms: holding company, parent company, subsidiary company, wholly owned subsidiary, partially owned subsidiary. What do these mean? My Sylvan Learning Center client started with the franchise, and he had to have a corporation. The franchisor in Baltimore said, okay, you can have a franchise, we'll sell it to you. You can set up in Vancouver, but we want you to do that through a corporation. So he incorporated a company. That is an operating company, okay? And then eventually his accountant said, for purposes of taxes, and again, accountants do this smoke and mirrors thing and save us all sorts of money. He said you should have a holding company which owns all the shares of the operating company, okay, and then you can do things like managerial transfers of cash into another company. They're both Canadian controlled corporations. They're taxed at a lower rate, all sorts of things like that. So he has a holding company and an operating company. The operating company would be considered a subsidiary. Well, yes, maybe no. Holding company parent is the parent company. The subsidiary is generally reserved for a situation where you have a holding company, and then you have one company that's making peak performance pontoon skis, one company that's making the Gladiator goggles, and another company that's making the power poles, so that you can again do some tax planning. Okay, so a subsidiaries, corporations' shares are owned by the parent company. A wholly owned subsidiary is a situation where the subsidiary, all the shares are owned by the holding company. But there may be a partially owned subsidiary. In other words, you may have a holding company and then two investors, and they own shares. Okay, so then it would become a partially owned subsidiary. So much for the nuts and bolts. So let's get down to a topic that I have some disagreement with. There is a buzzword out there, a term rather than a word, called corporate governance. And I don't like that, because corporate governance is the business doing its due diligence. The problem with that, it suggests that this due diligence governance is only for corporations. Okay, so that's my first disagreement with that. I think they should just call it business governance, because if you have a sole proprietorship, you want to do your due diligence because you're facing potentially unlimited liability. So the due diligence is risk management. You make sure you hire properly, you make sure you train properly, you make sure that you test your products coming off the assembly line. All those sorts of good things. Well, you do that in a sole proprietorship, you do that in a partnership, and you do it in a corporation. Okay, so I don't think they should call it corporate governance. I think they should call it business governance, because you should do it in all forms of business organization. The other disagreement I take with that term is I looked at some books out there, and there was one that was done for tourism business, and this is on slide 189, and it talked about this model of corporate governance, that if you do these things, everything's fine, and it gave the impression that, hey, here's your template, here's your rubric, just do this and everything's okay. The difficulty with that is every business is different. Okay, so I don't think that there's a template out there. I think what you should do is you should sit down and look at your operation, and you should say, okay, these are the risks that we're facing, and here's the things that we can do to either shift risk, reduce risk, or accept the risk. And then I think it would be really wise to then go to your lawyer and say, okay, here's our best guess of what we should be doing. What else? Okay, and then talk to your accountant as well. I know every time you go to them, it costs money, but it does not cost as much in the long run as failing to do your due diligence. So I think it's just a really good practice. Now, obviously, you have to have due diligence when you're taking care of the affairs of the company, and you have to do your due diligence when you're doing the business of the company. And if there's two people involved, one might be the president in charge of the operations, so they do the due diligence with the business. Then you have somebody who's the secretary of the company, pardon me, and they take and they do the due diligence for the affairs of the company. And what's that entail? Okay, on slide 191, we look at 5 articles, sections of the BC Business Corporations Act, which relate to the due diligence of the company as far as the affairs go. Okay, so one is section 27. If you have a corporation, you have to display the corporate name. If it is not apparent when somebody is dealing with you that you are a corporation, they will be able to sue you as a partnership or as a sole proprietorship. And there you've tried to limit your liability, and bam, you get sued with unlimited liability or worse for the liability under a partnership. Fellow by the name of Jim Pike used to own the McDonald's on Lonsdale. I don't know if he still does or not, but I remember thinking, well, it just says McDonald's. It doesn't say McDonald's Pike Ltd. Or McDonald's Pike Corporation, and so, gosh, he's not displaying the name. Well, I walked in one day to get a coffee because I drink their coffee and like their coffee, and on the wall it said Pike Limited. A sign, okay? So that would be deemed to be displaying the corporate name. On his invoices with suppliers, on his contracts with other businesses, everything in his correspondence, he would put down Pike Limited, doing business as McDonald's, and then he would put per, an authorized signatory, and sign it, okay? So you're displaying your name. If you fail to display your name, there's another section later on which kicks in and says you can have liability as a sole proprietorship or a partnership, and you can also be fined by the government. I don't think the government has ever fined anybody for that. But the personal liability happens. My all-time favorite client, Ray, I think you'll recall that was the pork chop theory of payment that we talked about earlier. Well, he was always getting sued, but this one time he wanted to sue someone, and he came in and he said that his operation was he was a wholesaler of gas fireplaces, and he generally sold to construction companies to install them in condos and things like that. But then there was a retail operator that said, hey, I want to buy some and sell them in my retail store. Okay? And he said, but I cannot pay for them. So what I'd like you to do is give them to me on 30, 60, 90-day terms, and I'll pay you later. Sound familiar? Well, that's how Ray used supplier's credit. This fellow wasn't using supplier's credit to expand his business. He was just trying to perpetrate a fraud. So he got the equipment from Ray, sold it, and then Ray doesn't get paid, and Ray calls him up and goes, hello, this number is no longer in service. So he drives down, the shop is closed, the inventory is gone, this fellow's gone. So Ray comes in, he says he wants to sue him. And I said, him, or does he have a corporation? Ray said, gee, I don't know. So we looked at correspondence between the two. We looked at the invoice that was issued to the company. It was issued to him, not to a corporation. We looked at the checks that had been paid for the some of the product or whatever. And we looked at the correspondence. Okay. and it all said, his name and the name of the business without an LTD, without an Inc., or without a corp. We went down to the business premises. There was the name of the business right above the door. No LTD, no Inc., no corp. Okay, so the presumption is at that point that you are dealing with a sole proprietor. So we launched a lawsuit in small claims court, fortunately, for I think $21,000 or something like that. And his defense was he attached to the reply a copy of his incorporation certificate and said you have sued the wrong party. The disaster here is we don't get to go back and sue the corporation, all right, because that would be res judicata. You've already dealt with it in this lawsuit. You cannot do that lawsuit. Well, we went to small claims court, and he was on the stand, and I said, is this your correspondence? Yes. Is this your the invoice that was given to you? Yes. Is this he had paid one or two small amounts by check and then owed lots of money. Are these your checks? Yes. Is this a picture of your business premises? Yes. And then I said to the judge that on none of these did he display the corporate name, and therefore, in accordance with Section 127, my client was able to presume that he was dealing with a sole proprietorship, not a corporation, and Ray was successful suing this person. So you have to display the name. Now, you have to have a registered and records office. What is that? Official documents have to be served on the business corporation. And so with the registrar of companies, you have to have a records office where you keep the corporate minute book that I've talked about, and you have to have a registered office for the delivery of documents. Now, lawyers and accountants will serve as the registered and records office for corporations. And it's a really good idea to do that because remember I had that one client that I said was an investor angel and he did not keep his company in good standing. Why? Because he moved his business premises numerous times, and when he did that, he gave notices of change of address to everybody but the registrar of companies, because who would think of that, right? So the notice to file the annual report goes out to a business address that is no longer correct, gets returned to the government. They don't have another address for you, and a couple of years go by and bingo, they strike your company off the record. So if you have a registered and records office with a law firm, two things here. If the lawyer doesn't keep you in good standing, you get to sue him for negligence. But generally that doesn't happen. The good thing about that is a notice comes in that says you have to file your annual report. Well, I know where my client operates. If he's moved 4 or 5 times, he's been in touch with me, so I know where he is, then I can locate him. All right? Okay, records to be kept. There are slots in that binder which say, in this one you put in the minutes of the shareholders' meetings, minutes of the directors' meetings. In this one is documents signed by the corporation. You have a central securities register, which is incredibly important now because that shows the shares that have been issued, who holds them, and the address, which is public information. And then if those shares are sold, it says when the share certificate is canceled and who obtained those shares. Okay, so you have to keep the records. And so somebody in your operation has to be assigned with that task and should diarize these kinds of activities. You have to file an annual report. You can do that yourself. If you fail to do it, you might get struck off the record. So again, if I handled about 30 to 35 corporations, and so I would every year contact my client and say, okay, send me $285 plus taxes and I'll file your annual report with the government. Are there any changes in the number of directors, any changes in the officers? And then I draft up consent resolutions of the directors and consent resolutions of the shareholders, send it to him, he signs them, bingo, back. Good standing, okay? Now, consent resolutions, I should explain that. Every year, a corporation has to have a shareholders meeting. Now, if you have 3 or 4 shareholders, you can get together and you can have a meeting. Hi, what are we here for? To discuss how things are going. How are things going? Fine. Okay, everything's copacetic? Yeah, well, we're making money. Things are humming along. Okay, what else? Well, we should appoint directors. Okay, let's appoint ourselves. Yeah, okay, well, we can do that. Who wants to be president this year? Well, I was secretary last year. I want to be president this year. Oh, okay, fine. Well, you can do all that, or you can just have a consent resolution and not bother having the meeting. We all agree that these people will be the directors in the ensuing year. Bingo, that's it, right? Same thing with the directors meeting. That would be a shareholders meeting. The same thing with the directors meeting, appointing the officers. You can get together, you can actually have a meeting, or you can just say, let's have a consent resolution. So out goes a consent resolution, and if you all agree, you sign it, it puts in the corporate minute book. Okay, directors and officers qualifications. This is set out in section 124. It's in the statutory material that you have available to you. And this is important because persons under the age of 18 or persons who have had a fraud conviction in the last 5 years or persons of unsound mind or persons that are undischarged bankrupts cannot be directors of corporations. My all-time favorite client, Ray, his business, when he finally stopped using suppliers' credit and managed to pay them off and everything, he was doing very well. He wants to go public, wants to be on the stock exchange. And I said, I caution you against doing that. He said, nope, want to do it. I'm going to raise money, going to buy that big house I always wanted. And so I said, okay, I don't do that work. You go to somebody else and you do that. And he has a couple of other people involved in his business now, and they're going to be directors of this public corporation. They're all ready to make their public offering, and the Securities Exchange Commission calls up and says, well, one of the fellows is undischarged bankrupt. So he can't be a director. And suddenly they're scrambling at the last minute to find another director to put on there. So, directors and officers, 18 years of age or over, not undischarged bankrupts, no fraud convictions. All right, so that's the due diligence in the affairs of the company. Now we're going to get into the due diligence in the business of the company. Okay, the business is what you do to make a buck. The affairs is keeping your corporation in good standing. Due diligence. It is in the BC Business Corporations Act. It is in section 142, and that is on slide 192. I'm just going to quickly read it. The directors and officers of a company must act honestly and in good faith. Duh, right? But hey, some don't. And in the best interests of the company. Okay, so that's key because that means the directors work for the company, not the shareholders. Okay, directors do not owe a direct duty to shareholders. And then the key one is subsection 2 or B, which says exercise the care, diligence, and skill of a reasonably prudent person, which doesn't mean you have to make perfect decisions every time. The directors of the Chamber of Commerce in Gibson, British Columbia, had a meeting and decided not to proceed with the project because they did not think it was financially feasible. A lot of people took exception to that, and 2 of them who had actually donated money for this and didn't get all their money back when the project was canceled launched lawsuits in small claims court. The judge in that case, and I got to handle it for the Gibson's Chamber of Commerce because I had joined after they made that decision and became a director. And they said, Peter, what do we do? And I told them that not to worry because, first of all, they had insurance, and we'll get into that in Chapter 9 very shortly, and that's the last chapter we're doing. They had directors' heirs and omission insurance, which means if they made a mistake and they did not do their due diligence and they had some personal liability, the insurance would pay for it. Okay? The second thing I said was, well, and then we got into the arguing in court, and the judge's decision said directors do not have to make the right decision. Everybody makes mistakes, but what they have to do is go through a process and make a judgment call. And if that judgment turns out to be wrong, they've done their due diligence. It's the best they could do. People make mistakes. The only time they would have personal liability is if they did not go through the process and if they made a mistake. Okay? So the cases, there were two of them, cases were dismissed against them because they had done their due diligence. Okay, risk management, due diligence defense. You have to establish that you operated to an acceptable standard of care and diligence, and that you exercised it as a director and officer of the company. Very important section. That's got to be on the final somewhere. The next duty of the directors in the business of the company is to disclose interests in contracts. This is going to be awkward because generally I would draw a diagram on the board. Okay, so you're going to have to use your imagination here. Here's the corporation. There are 5 directors. There is a president. There is a vice president in charge of affairs of the company. There is a marketing manager. There's an operation manager, and there's me. And I am the procurement officer. It is my job to go out and find patentable inventions. We then acquire those patentable inventions, make them in our business, and sell them. That's what we do. So here's our corporation. My job is to go out and find an invention. And here's this other corporation that has 2 shareholders, A and B. And it has the patent on the electromat, okay, the subject of our contract assignment, which I haven't drafted yet. But anyway, the electromat. And I go to the board of directors and I go, hey, we can buy the patent to the electromat and we can get it for $50,000 and we are going to make a substantial profit producing it. And the board of directors votes and they go, okay, acquire it. What I have failed to mention to the board of directors is that shareholder A and shareholder B that own the shares in the company that holds the patent, well, I'm shareholder B. So $50,000 is going to go to that corporation. The patent is going to come to our corporation, and that $50,000 is going to be divided up between shareholder A and shareholder B, and I'm going to get $25,000. So I have failed to disclose my interest in that contract. So interest in a contract doesn't mean, oh gosh, I'm interested in contracts. I find them very interesting. I sit up Saturday nights and just read contracts because they are so interesting. No, what it means is I have a financial interest in that company. So I have to disclose that to the corporation. What happens if I fail to do that? After they acquire it, even if it is successful, the board of directors finds out and they go, hey, wait, Peter, you didn't disclose that you got $25,000. Oh, gosh, did I fail to mention that? Well, Section 147 says I have to disclose my interest. That's the duty. Section 148 is not a duty of directors, okay? Section 48 is what happens if I fail to do my duty under Section 147. And what that means is I have to account for the profit. 40, 79, I made $25,000. No, I have to pay that $25,000 back to my corporation. Okay, so that's pretty clear. But what happens if the electromat is a good idea? I do have an interest in it, and I think our company should buy it and we should make it. I have to disclose the interest. So I go to the board of directors. We have a board of directors meeting, and I say, here's the electromat. I think it's really good for our corporation. I think we should acquire it. $50,000 is a really good price. However, I must disclose my interest in that contract. If that $50,000 is paid to that company, I'm going to get $25,000. Okay? Now, I'm going to step out of the meeting, and I get up and I leave, and the other 4 directors say, well, okay, he's going to get $25,000, but we're going to make a huge amount of money on the electromat, so let's go ahead. So they vote to buy it. I come back in and they say, okay, disclose your interest. We're going to go ahead with the purchase. Everything's fine. Everything's copacetic. Everything's great, right? No, it isn't. What you want to do at that point is you want to say to the 4 directors, I would like a record in the decision of the directors that I disclosed my interest, that I stepped out, I did not vote, and that you elected to proceed. Okay? Great. Everything's copacetic because it'll go in the director's minutes, right? No, I want the director's minutes in writing. I want a copy inserted in the corporate minute book, and I would like a certified copy provided to me. Why? Well, business is very fluid. Directors are coming and going, and this business is acquired by another business, and the corporate minute book is transferred, and the next thing you know, 4 years down the road, somebody says, wait a minute, way back in there, Peter Holden got $25,000. And and he didn't disclose his interest. And I said, yes, I did. I was there at the board of directors. And they say, prove it. Well, I can't find the other directors because they've moved on, or well, there's a resolution in the minute book, and when the transfer, the minute book went missing, and suddenly I have no proof that I've done it. They say, hey, you didn't disclose your interest. Yes, I did. Here's a certified copy. Oh. Okay, so you want to do those things. That's called due diligence, all right? All right, so that's disclosing interest in contracts. Then there's a section that seems pretty straightforward. It's section 153 that says you have to disclose conflicts of interest. Oh, wait a minute. Conflicts of interest means if you are a director or a senior officer of a company, and it could result in directly or indirectly in a conflict of interest with another company. Okay, so let's go back to my wife, who bought shares in TD Bank and shares in Bank of Nova Scotia. Is that a conflict of interest? No, it's not. Shareholders don't have a say in the operation of the corporation. Okay, directors do. She's not a director of either bank. If she was a director of both banks, that would be a conflict of interest, because how do you give the best advice to Bank of Nova Scotia when it would conflict with the operation of the TD? So you can't be a director or officer of 2 different companies that may have a conflict of interest. Shareholders do not do that, because all she can do is vote for the directors of TD and vote for the directors of the Bank of Nova Scotia, but she has no say in the operation of the company. So it's not a conflict of interest to be a shareholder and have shares in Apple and shares in Microsoft and shares in Google and so on. But if you're a director, then what you have to do is you have to go to the company and say, look, I'm a director of TD and I'm a director of the Bank of Nova Scotia. And they say, oh, that's fine. They wouldn't, but you could get permission to do that. All right. The next one is under Section 154, and it prevents sharp practices. So let's say we have a corporation, you and I, and we have $200,000 in the bank. Some disaster happens. We know the corporation is going to go insolvent. We're going to be sued for $5 million. Well, $200,000 is not going to go a long way to resolving the $5 million debt, right? So, hey, why don't we do this? We know this is going to happen, so let's declare dividends of how much? 200,000. I'll take 100,000, you take 100,000, and then when the corporation goes insolvent or is forced into bankruptcy, oh gosh, there's nothing there for the creditors. Well, that would not be appropriate, and so if you declare dividends and your company is insolvent, or it will put the company into insolvency, you are required to pay those back, okay? You have liability for that. Then let's not declare dividends. Let's sell our shares back to the company and get a return on capital. I'll sell my shares back for $100,000, and you sell your shares back for $100,000. Oh, perfect. Okay. Well, you cannot do that. Okay. If you have a return on capital, then that either puts the company into insolvency, or if it happens when the company is insolvent, you have to pay that money back. And you have to be a little careful when you're doing this kind of finagling, because let's say I get $100,000 and you get $100,000, and I leave the country because I have no connections here. You have to pay your $100,000 back, right? No, this is joint and several liability. You have to pay the full $200,000 back, and then you can come and sue me if you can find me. Okay, so you don't want to do these kinds of things. Third example covered by this section is I have a corporation, I am the sole shareholder, I am the sole director, I am the sole officer. There is $200,000 in the bank. I know it's going to go insolvent, so I cannot take dividends, I cannot return capital, so why don't I make a loan of $200,000 to my wife? She can use that money to put in a down payment for a house. She'll be able to cover the mortgage from her previous job. And hey, bingo, we've got a house to live in because it's in her name and my creditors can't go after me. This is prohibited as well. Well, wait a minute. The corporation still exists. The corporation could launch a lawsuit against my wife. So how does a corporation launch a lawsuit? The directors. I'm the only director. I'm not going to sue my wife. She'd kill me. I'm just kidding. I'm not going to sue my wife. So in effect, here's a loan that could never be recovered. Okay. There's a provision in the Corporations Act that the shareholders can start a lawsuit if their directors don't. Yeah, but I'm the sole shareholder. I'm not going to sue her. So the Section 154 prohibits giving a loan if the company if the company is insolvent, or it would put it into insolvency. How are we doing time-wise? Let's see here. Okay, that's 38. Yeah, we can go for a bit longer. All right, the next duty of directors is to refrain from insider trading. If you don't know what insider trading is, I used to have a joke. I'd say, if you don't know what insider trading is, just ask Martha Stewart. And everybody goes, who's Martha Stewart? She was a business person in the United States. Had books, had a show on TV about, home decoration and stuff. And, pardon me, I'm having allergy attack. I'm going to have a break here in a minute and go and take an allergy pill. I'll just try to finish this topic. She knew something about how her company was going to suddenly become more valuable, and so she bought shares because she had insider knowledge, and she got caught, and she actually went to jail. Insider trading is when you, as a director or an officer of the company or some other prohibited categories of persons, have information about the corporation that the public doesn't have. And so you act upon that either to sell shares before the company goes into insolvency or to buy shares because they're going to expand. All right. Insider trading, can't do it. Give you an example. I love coffee. See, I'm always drinking coffee. And so my perfect job would be as a manager in the operation of the Gotta Have a Java Corporation. Okay. I think that's a super name, and I've been using it for years, and I can't believe anybody out there hasn't taken it yet. Gotta Have a Java Coffee. So I get a job at the company, and I like to get into the office. Like I'm not serving coffee. I'm in the head office, right? So I come in early because I like to get in early, get a lot of work done before the day gets busy. And the nice thing is, one of the office boys comes in and gives me a cup of coffee, and and I'm just going to take a drink, and somebody bursts in the door and says, "Don't drink that." And I go, "What? What the heck's going on?" And the guy says, "Toxic waste got in the coffee beans, last shipment, poison, gone out to all the store. People are going to be sick and dying all over the place. This is terrible." And he rushes out. Okay. I pick up the phone. Well, actually, what I do is I pick up my cell phone. "Hi, Bob. Peter Holden." Bob's my broker. "Bob, I hold some shares in Gotta Have a Java, and I would like you to sell those for me." "Why?" "Oh, career change." Yeah. "How much?" "Oh, just, whatever you can get. Just, sell them quickly. I want to make a move, fast." "Yeah. Okay. Thanks, Bob." That is insider trading. I, as a director or officer of a company, have knowledge about a problem in the corporation that the public doesn't have. I'm going to sell my shares, get my maximum amount of money. You're going to get zip. So that's prohibited. Now, I can sell my shares, but I have to contact the Securities Commission, and I have to register my intent to sell. All right. And that, and then, Bob, my broker, Bob wouldn't be involved in it, but let's say Frank is your broker, and Frank gets up every morning at 5 o'clock and he looks at the record of insider trading and he goes, "All the directors and officers have Gotta Have a Java are going to sell their shares in 3 or 5 days or something." Then your broker is going to call you and say, "Look, you hold shares in Gotta Have a Java. I don't know what's going on, but all the directors and officers are dumping their shares. I suggest you sell right now." That's okay, right? That's not insider trading. That's public knowledge. But inside the corporation, you have to be very, very careful. Who's covered? Section 192, subsection 1 says directors, officers, managers, anyone who has a position and gets that kind of knowledge, like lawyers and accountants. Now, I don't hold the shares and Gotta Have a Java. I gave everything to my wife, right? So no problem. I just call my wife. "Hey, sweetie, just dump those shares." Cannot do it. She's considered to be an insider as well. I had one client come to me and said, "Okay, I'm going public. I want you to do this work for me, and I'll give you shares." And I went, "No, thank you," because the idea was that the corporation would go public, and then I could immediately sell my shares as the stocks go up. And I thought, I'm not getting involved in insider trading. Okay, really cute cartoon on 197 that deals with insider trading, and I think it's kind of fun. Just take a look at that. Now we're going to have a short break. All right, well, I've had my little break, and obviously after talking about Gotta Have a Java so much, I needed a coffee, and so I went out and got one, and now we can continue with the duties of directors towards the business. Okay, we've dealt with the duty of directors towards the affairs of the company. Now we're finishing off the duty of directors to the business of the company. Up until now, we've been looking at Section 142, Section 153, Section 154, Section 192, they're all related to the corporation, okay? And I think section 147, if I didn't put that in there. We've looked at 5 statutory requirements for the duties of directors. Now we're going to look at a common law duty of directors. So we have a statute that dictates duties, and then there's one common law situation not covered by the statute. And this is a bit of a real strange bird. It's called interception of a corporate opportunity. It used to be called abuse of a corporate opportunity, but abuse has taken on a bad connotation, and so they didn't want the confusion. Now they refer to it as interception of a corporate opportunity. Remember the example where there was a corporation, 5 directors, and I was the procurement officer, and I went out and I looked at this corporation over here that had the patent for the electromat. And I was a shareholder over there, so I had to disclose my interests under Section 147. Let's change that scenario a little bit. Let's say there is the corporation, there are 5 directors, and I am the procurement officer. But instead of a corporation over here that I have an interest in, there's just someone over here, Myron Entwistle, okay? And he owns the patent. Myron comes to me and he says, he's a kind of a mild-mannered man. Hello, my name is Myron Entwistle, and I hold the patent to the electromat. And he gives me an example of the patent, and he shows me, and I look at the possible cost of producing it and everything, and I think, this is a really good opportunity for our corporation. I run the numbers, and I think, we buy it for a nominal sum, $50,000. Myron gets it. I have no interest in that money. Okay, Myron gets it. And then the electromat is produced by our corporation. And in the first year alone, we're going to make $5 million profit. Wow, there's 5 of us, $5 million profit. We can each take out $1 million each. Or if I was to form a corporation and I was the sole shareholder, director, and officer, and I produced the electromat, instead of making $1 million, I'll make $5 million. That sounds better. Okay, well, what I have done as a director is I have intercepted a corporate opportunity, okay? That opportunity should have come to our corporation, but I have intercepted it for my own personal benefit. This is prohibited at common law, and it even gets a little weirder, okay? Now, I'm a director, and so that's interception of a corporate opportunity. Well, what I'll do is I'll resign, and I'll sell my shares so I'm not involved in the company, and then I'll do it. Cannot do it. It's a corporate opportunity. I learned about it while I was a director. It can never, ever, 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 and did I say never, be my own opportunity, okay? Well, all right, let's try something a little different. I take the electromatic to the board of directors, and I say, here's a really good opportunity for us. And I can't believe it. 4 of the 5, meaning I'm the 5th, say, no, we don't think so. And I go, no, it's fantastic. We're going to make a lot of money. No, I don't think so. Well, okay, can I do it on my own? And the 4 of them say, yeah, sure, okay. And I go off and I make $5 million. The weird thing is that corporation can now come back to me and say, hey, guess what? We know we said you could do it, but that was a corporate opportunity. You have to pay the $5 million to us, and they will be successful. Okay? Doesn't seem to make a lot of sense, except to prohibit any activity like that because it can cause so many difficulties. The Supreme Court of Canada, in the Can Arrow case, said you cannot do that. Ever, 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 ever. Okay. So how can you do it? You can't. You cannot do it. I went to a continuing a legal education seminar to update my skills as a lawyer. There were 60 of us in the room. One of the lawyers who's presenting gives this case, says that it's a corporate opportunity, you cannot intercept it. 60 hands go up. So how do you do it? He says, you're not listening. You can't. There is no way that you can ever protect yourself completely. Okay? You can have a signed resolution by that corporation saying, we're not interested. You can have it. Doesn't matter. Okay? It's a corporate opportunity. If it's a corporate opportunity, it's a corporate opportunity. It's a corporate opportunity. Okay, let's say Myron Entwistle drops by my place Saturday night. Myron and I are good friends and we watch, football. Well, Myron tells me about it then. I'm still a director in charge of procurement, and I should recognize that as a corporate opportunity and not intercept it, okay? 60 hands go up. Okay, sure, that's fine, but how do we do it? And the argument went on for quite a while with the fellow saying the Supreme Court of Canada said you cannot do it, period. Okay? Now, if Myron Entwistle had an idea for a service and he and I watch football on Saturday nights together, or Monday Night Football, I guess it is. And he comes over and he tells me about this service, and I go, wow, that's a really good opportunity. Yeah, Myron, why don't you and I form a company and do it? I'm going to be okay. Why? Because our business does the development of patentable technology. A service business is not within our type of operation. Ergo, that would not be deemed to be a corporate opportunity that our business should do. It's completely different, so I could go off and do it. Okay, so that's interception of a corporate opportunity, and the law hasn't changed. All right. Okay, so the next slide. We get into a very important topic. I mean, everything is important. There is so much more that we cannot teach you in this course because we just do not have the time. So what we have done is we've taken the most important topics and put it into the course. So everything's important. The next one, though, as far as corporate liability and limited liability goes, this is extremely important. In the case of W.D. Latimer versus Dijon Investments Ltd., the Ontario Supreme Court judge looked at this whole concept of limited liability of a corporation and said it cannot be blanket limited liability. There are certain circumstances when the directors and officers of a corporation should be held liable for the actions of the corporation. And so we have the corporation and we have this corporate veil of protection. And what this judge said was under certain circumstances, that veil of protection should be pierced so that the shareholders, directors, and officers of the corporation can be held liable. Okay. And I think on slide 201, I've got this funny little cartoon where there's the shield, which is the corporate veil, and an arrow's piercing it, and ouch, all right? So when can this happen? Well, the judge said, okay, the whole concept of limited liability is important, incredibly important to our economy, to the well-being of our society. To generate investment in business so that we can hire people and everything. He said, so what I want to do is I want to say, yes, the corporate veil can be pierced, but only in certain circumstances. And he likened it to the concept of tortious liability for negligence. We don't have blanket liability for negligence, okay? Only in a circumstance when the plaintiff can prove that the defendant owed him a duty of care, that the defendant breached that duty of care, and that the defendant actually caused damages. So he said that same kind of limitation is going to be used here. And what he said was a wrongful act or omission by a director or an officer or a shareholder must be through the use of the control of the company. It must contravene the plaintiff's legal rights, and it must be the proximate cause of the loss. Sounds like duty, breach, damages. Okay, so it's the same kind of approach. So let's look at control. Now, if you're a person and you are negligent, you have control. Okay, you were negligent, you didn't stop, you didn't think it through. Well, okay, a director or officer of a company must have control. This does not mean 51% control, but it must be in a position where you're making decisions for the company. Okay? All right, and then you must contravene the plaintiff's legal rights in some way. Okay, so that means breach of the matter. And then the decision that you make must cause the loss. Let's deal with the last one first of all. We have a corporation. I'm the president. I'm giving myself a little bit of a bonus every year, a little bit of extra cash that nobody knows about. So over the years, it's to the tune of $120,000. There is a disaster in the manufacturing, and the company goes insolvent. In the reckoning of the insolvency, it comes to light that I took that $120,000. Well, you're not going to be able to pierce the corporate veil and come after me because you, as a shareholder, have suffered loss because I took the $120,000. Why? Because the disaster that happened caused the bankruptcy. My actions did not cause the bankruptcy, so I can be charged the offense of embezzlement, but you cannot pierce the corporate veil and go after me. Why? Because your loss was caused by the disaster, not by me taking the $120,000. All right? Now, in control, the supervisor on the line is controlling the employees, but that's not what we mean. Okay, control means I'm the person that makes the decision to do the electromat, and it turns out that that's a disastrous decision and I should have known better. Then obviously I'm in a position of control, and I contravened the rights because I did not do my due diligence. Due diligence comes back, right? So I'm in control, I didn't do my due diligence, and my actions in failing to do my due diligence caused your loss. A number of years ago, there were only a few situations where the corporate veil has been pierced, and over the years, the list has gotten longer and longer and longer. Some textbooks, most textbooks, talk about piercing the corporate veil. I look at it a little differently, and yes, I might be saying, here's how I distinguish my textbooks from the other, but I honestly think I'm not just distinguishing it by coming up with an artificial construct. I think that this is the better way to look at it. There are numerous situations where the corporate veil can be pierced, so you're going right through the corporate veil, and you're making certain directors and officers liable. Then there are two situations when there's the corporate veil, but I'm not piercing the corporate veil, going through the corporation to go after the directors and officers. I'm actually circumventing the corporate veil. I'm saying I'm not going to try to pierce it. I'm going to make people liable so that I can go after them without piercing the corporate veil. Okay, so I've broken it down into two categories. The first category, piercing the corporate veil, is on slide 200, and there are, my goodness, 13 of them now. And then on slide 201, I've put down two situations where the corporate veil is circumvented. Let's look at the list for piercing the corporate veil. Under the BC Business Corporations Act, it says if you start to incorporate a company and you sign contracts in the corporate name, and then the company is incorporated and begins operating, the company can actually agree to take over the obligations, okay? Because if you sign a contract with a supplier before the company comes into existence, think about it. Peak Performance Pontoons Inc., per authorized signatory, and Benton Counter signs that. Corporation doesn't exist, take that away. You cannot be an authorized signatory for that, take that away. Got to take per away because you're not signing on behalf of anything because the corporation doesn't exist. What's left? Benton Counter signature. So if you sign a lease before the corporation comes into existence, if you sign a supplier contract before the lease comes into existence, suppliers for inventory, suppliers for services like hydro and things like that, and then for some reason the corporation does not begin operating, this is called pre-incorporation contracts, and Benton Counter will be held liable. It used to be you're liable regardless, but under the new BC Business Corporations Act, they put in a section that says the corporation then becomes a agent and can ratify. You are acting as an agent for the corporation, and then the principal corporation can ratify those contracts. Okay, I jumped the gun. I entered into a contract, but the principal says it's okay. I'll take over liability. So once the corporation begins operating, and once the corporation begins to pay the lease, and once the corporation begins to pay the suppliers, the corporation is deemed to have ratified the pre-incorporation contract, and you have no longer any liability on it. However, if you're beginning to form the corporation and you sign these agreements, and then for some reason you don't get the funding for the corporation, or you get into arguments with your business associates, that sort of thing, then and the corporation doesn't go forward, you have pre-incorporation contracts on which you will be liable, but only the person signing it. Okay, so let's say there's 5 people that are going to be shareholders, directors, and officers, and I sign the lease and I sign the supplier contracts. Well, it's my name on there. Okay, the other 4 that we're going to be involved in haven't signed it, so I'm the only one that's liable. All right, pre-incorporation contracts. Family law in Ontario, and this is in the textbook. In Ontario, there was a case where a very rich person had all the family assets in his name, and he one day looked at his wife, and then he looked at his blonde secretary, and he thought, gosh, she's better looking and younger, and so he leaves his wife, I'm simplifying it a bit, leaves his wife and takes all the assets with him. Now, he knows there's this Family Relations Act in Ontario, like our Family Law Act, and what's that going to mean? It's going to deem that all the assets are owned 50-50. He's going to leave with his blonde secretary, but his wife is going to get 50% of the assets. So what he does is he forms a whole bunch of corporations, the shares of which are held by other people in trust for him, so his name doesn't appear, and he transfers assets into those corporations, and then he leaves. And his wife says, I'm not getting very much. I thought you were worth way more than that. And he goes, nope, that's it. Well, she sues anyway, and then through examinations for discovery and witness testimony, his house of cards collapses, and the court finds out that he has all these assets hidden away from his wife, and the judge in that case said that he is not going to allow the corporate concept to be used by someone to defeat their obligations under the Family Law Act. Okay, that's Ontario statute. We have the same statute, so it's applicable out in BC because we would follow the law in that jurisdiction. All right, fraud. Now, pre-incorporation contacts, family law, only directors and officers are liable. Fraud is a situation where the shareholders, directors, and officers are liable. So this is the only one where a shareholder can be held liable. Wouldn't it be nice if I formed a corporation, got product on 30, 60, 90 days, sold it, closed down the corporation, and took the money. I'm doing it just for to perpetrate a fraud. So, in fact, as it turns out, I own the shares, but I didn't appoint myself as a director, didn't appoint myself as an officer. I've contravened the statute, but like nobody would care about that. But you go to sue, and well, you can't go after the directors and officers because none were appointed. Well, I've used my position as a shareholder to perpetrate a fraud. You perpetrate a fraud, all bets are off. The corporate veil can be pierced. Taxation. Obviously, if a corporation does not pay its taxes, then the Canada Revenue Agency is going to be able to go through the corporate veil and go after directors and officers that were responsible for remitting the taxes. There is a defense here of due diligence, and there is an example in the lecture materials. There's a little head note from a case, and in a minute I will dig that out to give you the right page. But what happened was an immigrant to Canada, became a Canadian citizen, didn't speak English very well, got involved in a business, and there were a number of directors, and he was one of them, but he really didn't understand, what being a director meant. And he was running the operation, and the other directors were responsible for paying the taxes. And this duty is joint and several. They can go after everybody. Oh, so everybody can own it, right? And so what happens is the corporation goes insolvent. The other directors disappear, and he's there, right? So the Canada Revenue Agency goes after him, and he said, I didn't understand any of this. And they said, okay, well, obviously you had done your due diligence to the best of your ability, and so they let him off. I'm not sure I agree with that, because if you're becoming a director in a company, maybe you should consult your lawyer and find out what your responsibilities are. But they said, okay, we're going after the other two jointly and severally. You had done your due diligence to a certain degree, so you have this defense, all right? But you don't pay your taxes. The Canada Revenue Agency can pierce the corporate veil and go after the directors and officers jointly and severally. Now, you have to be a little careful here, because one of the easiest people not to pay when things start going wrong. So you start a business and you're operating, and the COVID-19 starts interfering with your ability to sell product, and profits are going down, and suddenly you're in the red. You want to continue operating. You want to see if you can get through the pandemic and continue operating. So you're holding on as much as you can. So you start delaying paying your suppliers, right? You start delaying paying your taxes, and you start delaying paying your WCB. Well, the suppliers can yell, but we'll come back to them later. Canada Revenue Agency probably will not even notice for a long time that you're not paying taxes, because it's on a voluntary basis. It's, they expect you to do it, and if you don't and they find out, then they come after you. So it's easy not to pay the taxes. The problem is, if COVID lasts too long, business goes insolvent, they'll pierce the corporate veil and go after you. Criminal negligence. I think if a Canadian business said, you have to continue working, and if you don't, we'll fire you. And if you have a mortgage and a car loan, and your kids need braces, and you might almost be forced to continue operating. When the owners of the business know that it's dangerous to do so, then that would be criminal negligence. And if you are seriously injured or you died, we have a new section in the criminal code that allows them to be charged with the offense of criminal negligence, and allows the people that were injured by the criminal negligence to pierce the corporate veil and go after those people involved. This provision was put into our criminal code after the West Ray mining disaster in Nova Scotia. So there's a mine in Nova Scotia. They're getting coal out of the ground. The manager of the plant knows that it's extremely dangerous, that their safety precautions aren't in place. They continue operating. There's a disaster. 63 miners, I think it was, were killed. And that manager is criminally negligent and gets sued for causing wrongful death. Okay, but he doesn't have any money. I mean, you don't personally have enough money to compensate 63 people for wrongful death. So they looked at the directors of the company who were in Toronto or somewhere, and they all went, "Whoa, we didn't know it was dangerous. Safety precautions not being taken care of? We didn't know." And none of them were held liable. All right. We now have this criminal negligence section in the criminal code, which says that even if you don't know, you are deemed to know because it's your duty, it's your due diligence to know. And so since that section has been put into the criminal code, there have been 3 cases where there have either been the person pled guilty or they were found to be guilty. 2 in Quebec, 1 in Ontario. There was the BC Ferries had a ferry sink off Prince Rupert, and there was a case involving that, but it was settled, so we don't know anything about it. So this provision is there, and it does operate, and the owners of the business were held to be personally liable for the problem, and the corporate veil was pierced on the basis of criminal negligence. Now, negligence there is not the same as the tort of negligence. Okay, criminal negligence is completely different. Okay, human rights. If you discriminate, the corporate veil can be pierced, and the business can be held accountable. There is a good example in the textbook, and I recommend that you read it. And it seems to make sense, because if you said, well, okay, the corporation hired the employee, I didn't hire the employee, I'm just the agent for the corporation, and the corporation should be sued or held accountable. That doesn't make any sense. All right, so if you if under the Human Rights Code you discriminate, or if you don't have pay equity, then the corporate veil can be pierced, and the person responsible can be held accountable. Environmental protection. All provinces have environmental protection legislation. The federal government has environmental protection legislation. Whether it's working adequately or not is another debate, which we don't go into here. But we do have this provision. And there's a case in Ontario that demonstrates the operation of this provision perfectly, and it applies to BC because our statutes are very similar. There was a business operation that made a product in Ontario. The product, I can't even remember what it was, it's unimportant, but one of the byproducts of the manufacturing process was a toxic waste. Well, the business is operating. There's a president who oversees the whole operation. There's the operation manager that actually supervises the making of the product. And then the third director officer was the financial officer who worked out of his home, okay, kept all the books and records for the company, would come down periodically and find out what the receivables were, and he'd pay the payables, and he'd ask his other 2 associates, how things were going, and they would say, oh, okay, everything's fine. Then he would go back to his house. And eventually, the barrels of toxic waste began to pile up. And the operation manager says to the president, we've got to do something about this. And the president says, okay, I'll take care of it. And he calls the Ontario government that has a waste management disposal site. And he says, we got this toxic waste, come and get it. And the province says, we don't pick up, you have to deliver. So the province will dispose of the toxic waste safely as long as you can get it there. So the president contacts a hazardous waste transportation company and he goes, whoa, this is too expensive. I mean, it's really expensive to carry toxic waste by truck, right? Because of the potential liability. So the president says, we can't afford that. And the operations manager says, well, why don't we put lids on the drums of toxic waste, secure the lids, send it by train. So the two guys do, and what train derails? That train. It's called Murphy's Law. If anything can go wrong, it will. So the train derails, the barrels fall over, the tops pop off, and this guck goes into the ditch beside the track, which goes into a stream, which goes into a river, which is the water supply for a nearby town. Well, fortunately, someone from the railway company goes, I don't know what that is, but that does not look good. And so they call the government, and the government sends in a SWAT team whose job it is to sit around and wait for environmental disasters and then swoop down and take care of them. And the judge in the in the case wrote a judgment that sounded like a novel. He described what had happened and the toxic waste in the dish, and then he said, out of the morning fog came these helicopters that landed, and out came men in suits that looked like they were from Mars, hazmat suits, and they dammed the ditch and they scooped the muck up and they took it away. The cleanup bill was a little over $1 million. So the Environmental Protection Agency turns up at the plant and says to the operation manager, here's the provincial bill for the toxic waste cleanup. The operation manager looks at it and he goes, oh man. He calls the president and they go, oh, well, that's it, we're out of work. So the president turns to all the employees and he says, all right, everybody, pack up, go home, you're all out of work. Okay? And they close the plant down because everything was done in the corporate name. So the shipping invoice was the corporate name, the payment was in the corporate name, so it was a corporate liability. Okay, so they go home, and the next day at the president's house, there's a knock at the door. And he opens up and he goes, yes, hi, I'm from the Environmental Protection Agency. Here's the bill for the cleanup. And the president goes, oh, no, that's a corporate liability, so you go down here 12 blocks, 2 blocks that way and 1 block over, and just, nail it to the door because it's closed. Guy from the Environmental Protection Agency looks at it and goes, no, your name's on here. The president goes, what? And he looks at it. The corporation is liable, he's liable, and the other 2 directors are liable. Okay? So, a copy of the bill is delivered to the operation manager, and a copy of the bill is delivered to the financial manager. Remember, the financial manager wasn't involved in this, so he gets the bill and he says, here's the bill for the cleanup. The financial manager goes, what cleanup? Well, the environmental spill. What environmental spill? Because he was not consulted about this. Okay? So, and when the dust settled, the president was held liable, and the operations manager was held liable, but the financial manager, the chief financial officer, no liability. Why? Because he had done his due diligence. He goes down to the plant as he's supposed to. He takes care of the receivables. He takes care of the payables. And he asked his business associates, how are things going? And they said, fine, except for the toxic waste. So do you as a director and officer in the company have to go to your associates and say, is everything okay? Oh, yeah, everything's fine. Are you sure? Are you sure? Are you cheating? Are you doing something wrong? You don't have to do that, okay? If you make reasonable inquiries, hi, how are things going? Everything okay? And they say yes, you've done your due diligence, okay? Under certain circumstances, there might be something more that you have to do. But as far as this chief financial officer was concerned, he wasn't involved in the decision and didn't know anything about it. So he did not have any liability. The other two, however, did. And as it turned out, the president of the company had just finished paying off the mortgage on his $1 million house. Not a nice way to lose your house, okay? So environmental protection legislation, the corporate veil can be pierced and the directors and officers can be held liable. All right, employment standards. If you do not pay your employees, then you will be held liable for up to 3 months unpaid wages. It's just been reduced in the province of British Columbia to 2 months. All right. So what's this mean? Well, back to our Ontario example, where it is still 3 months, I believe. The president of the company, after the environmental disaster, turns to all the employees and he says, all right, everybody, we're out of work, the business is closed down, go home. What he did wrong was he did not give them the right amount of notice. Remember that an economic downturn is not a reason for failing to give the notice required under the statutes. Okay. So the Employment Standards Act says they are supposed to receive a certain number of weeks' notice. If you're an operator, if you're a supervisor, you might be required to get 1 month's notice. So he didn't give notice to anyone. So he's required, the president and the operations manager, and in this circumstance, the chief financial officer might have a due diligence defense, but the operation manager and the president would be required to pay up to 3 months unpaid wages. In BC, 2 months unpaid wages. What's that mean? Well, I have a line operator, just a regular employee, and he's entitled to notice under the Employment Standards Act. So he's been there for 7 years. Well, he's supposed to receive 7 weeks' notice, right? But I just said, okay, go home. Well, he will be entitled from the corporation to receive pay in lieu of notice, but the corporation is insolvent, right? So he can pierce the corporate veil, and the president and operations manager will have to pay the 7 weeks. Oh, didn't I say up to 3 months? Well, yeah, but he's only entitled to 7 weeks. So that's all he's entitled to get. The supervisor, who might fall into the managerial category, has been there for 11 years. Well, he's entitled to 11 months notice that his job comes to an end. So does he get 11 months pay? No, he doesn't, because the business is out of operation. However, he will get 3 paid by the directors and officers. Okay, so he doesn't get 3 from the president and 3 from the operations manager. He's just entitled to 3 months. At least that's some protection. In the province of British Columbia, the NDP, very pro employees, have been in power for a while, but I don't think they've changed the provisions in the Employment Standards Act, which was amended by the previous Liberal government, very business oriented. So they said, hey, let's not punish the businesses. Let's give them a break here and say 2 months unpaid wages. Okay, but the statute, the Employment Standards Act, will dictate that. All right. Some statutes say up to 6 months unpaid wages, so that's a big hit. So you want to make sure you give them notice or pay in lieu of. Okay, that's employment standards. Workers' compensation, you have to pay workers' compensation. Things start going south, pandemic, losing money, stop paying WCB. If somebody's injured, WCB will say you have to bring it up to date, pay it what was there. There will be a penalty and some interest on the money that you owe the government. Okay, pierce the corporate veil. Competition Act. Federal statute, there are some provincial statutes that would operate the same way, but let's just use the Competition Act. The Competition Act has provisions that says no price fixing, no abusive dominant position, a whole bunch of provisions. One of them is false and misleading advertising. So I'll use that as an example because I have some experience there. Years ago, the Ford Motor Company sales were down. And so they decide to say, okay, let's have a promotion whereby we'll sell a certain car at a ridiculously low price, air conditioning included. So they agree. Ford Motor Company sends out this information to all their dealers across Canada. This car, low price, air conditioning included. Those dealerships all across Canada go to their ad agencies and say, we want ads for selling this car at this ridiculous price, air conditioning included. The ads go out, people pour in, they want to buy the car. Turns out the car does not come with air conditioning, never has, never will. Okay, so this is false and misleading advertising. Ford Motor Company is charged with an offense. The dealers are charged with an offense, and the ad agencies were charged with an offense of false and misleading advertising. The ad agency in Vancouver that did the Ford Motor Company account came to us and they said, our company has been charged with an offense. And then right after that, the president of that company comes in and he says, I have been charged personally. So they pierced the corporate veil and they said, okay, we're not going to charge the corporation with a crime. Take the corporate minute book, which is the company, and put it in jail. Like, who cares, right? So what they do is they pierce the corporate veil and they make somebody in that company personally liable. So the president was held personally liable. And I had the pleasure of going down with him to 222 Main Street to the provincial criminal court there, which is, if you have been there, not a very nice place. Okay, they try to keep it as tidy as possible, but you have drug dealers and pimps and prostitutes. Oh, pardon me. What do they call them now? Night workers or something. They all come in there, and it's not a very nice place. And we were down there, and in walks, this president of this company, and he's in his Armani suit, right? And we're walking in, and he goes, "Oh my God, what am I doing here with all these criminals?" And I said, "Well, I was joking, and I said, "Well, if we lose this case, you'll be one." And he went, "Oh," and he was just like absolutely terrified. And and I went, "Ooh, I should have been a little more careful in what I said." Anyway, we go into the court, and all he has to do is stand up and say, "Not guilty, Your Honor." It's Your Honor because it's provincial court. It's my lord if you're in Supreme Court. But not guilty, Your Honor. And he could barely get it out. Not guilty, Your Honor. And I don't plead for clients, okay? Some lawyers do, but I was told very early in my legal career not to plead for the client, because then the client comes back and says, I wanted to say guilty, but you said not guilty, and then you're in trouble, right? So you make them plead. So he pled not guilty. And I looked at him and I thought, wow, he's really upset by this, because just a week earlier, he made a presentation to the Board of Trade in Vancouver, and he was standing up there and he was confident and he was self-assured and he was doing this presentation, and then you see him pleading not guilty, wow. Big difference. Anyway, what I did was I went to the Crown Prosecutor and I said, okay, the Ford Motor Company makes this car. They should know that it does not come with air conditioning, and it cannot. Okay, the dealers whose job it is to sell Ford Motor products should know that this car does not come with air conditioning. Does the ad agency know that this car doesn't come from air conditioning? Should they know it doesn't come from air conditioning? Should the ad agency account manager have to go down to a Ford Motor lot, lift up the hood and go, wait a minute, there is no air conditioning in here. Hey, wait, this doesn't come with air conditioning. No, they should be able to assume that the information that they've been given is correct, because Ford Motor Company makes it. So the upshot was that the Crown Prosecutor said, yes, you're right, and they dismissed the charge against the At least our ad agency. I don't know what the other lawyers did, but I'm sure they did the same thing. The Ford Motor Company, however, somebody in the Ford Motor Company was personally charged, okay? And the dealerships, every one of them is a corporation, and somebody in there was personally charged. So they pierce the corporate veil and they go after somebody inside the corporation who they think is responsible for the contravention of the Competition Act. The BC Business Corporations Act, Section 154 and 158. 154 is the section which says payment of dividends, payment of or return on capital or loans by the company when it's insolvent is prohibited. Okay, you can be fined under the Company Act, but more importantly, the person that is loses money because of that, other shareholders or whatever, can pierce the corporate veil and go after the directors and officers of the company. All right, we're going to take one more short break here, and I will come back and we will complete this chapter. Okay, continuing on with piercing the corporate veil. The last example on slide 200, number 13, is the Canada Consumer Products Safety Act. The federal government came in with a statute which requires a corporation, when it's making a product, to report if their product injures somebody. And if you fail to do that reporting, then they can charge you with an offense, and they pierce the corporate veil and go after somebody in the company personally. If your product doesn't injure somebody, but possibly could, like Peak Performance pontoon skis, then your company must do testing to make sure that the skis are adequate, and they must track the skis as they go out so that they can find out which one by the serial number was made on such and such a date, and then check others close by to find out if other products went out that were defective. And you fail to do that, then the corporate veil could be pierced, and the person responsible in the company can be fined. This is quasi-criminal. There's punishment, but it's not a criminal statute. You don't walk away with a criminal record. You walk away with a fine. So there are 13 ways that the corporate veil can be pierced to make the a director or an officer inside the corporation liable. And then the only situation where a shareholder can be liable is they'll pierce the corporate veil when the shareholder is involved in the perpetration of a fraud. Circumventing the corporate veil is my explanation of the next two items. Guarantees and covenants. What's the difference? Not a lot as far as liability goes, but it's more semantics and more the type of contractual arrangement that is different. A guarantee, I have a corporation, somebody like a bank lends money to the corporation. They may know that if the corporation goes insolvent and cannot pay that loan back, the lender cannot pierce the corporate veil and go after the directors and officers, and certainly cannot go after the shareholders. So what happens is banks in particular, some lenders, yes, most lenders don't. They don't think about it, but the banks, for example, know that they could be left on the hook. So what they do is they say, okay, we will lend money to the corporation and there will be this contract to pay it back. If for any reason the corporation fails to pay it back, then we want a director or an officer to sign personally that they will pay if the corporation cannot. Now remember back when we were talking about seals that those documents have to be signed under seal. Why? Because there is a contract between the corporation and the bank. Money is going from the bank to the corporation, and the corporation is going to repay that money plus interest. So there's consideration going both ways. Benton Counter signs a guarantee for Peak Performance pontoons. What consideration is he getting? Well, the bank is getting consideration, his promise to pay if the corporation cannot. But what is Benton getting? Nothing. Okay? So that agreement would be unbinding and unenforceable, except the bank will say sign under seal, and the seal has to be affixed at the time or before the contract comes into existence. So that's a guarantee. The covenant occurs between a landlord and a corporation. I form a corporation and I go to the landlord and I say I want to enter into a lease. So the landlord is willing to enter into a lease with your corporation. What happens if the corporation cannot pay? Can the landlord pierce the corporate veil and go after the director or officer? No. Why? Because again, the consideration is here, but there's no consideration for the covenant. So what happens is the landlord will sometimes say, I want to have a covenant that you, Benton Counter, will pay if your corporation cannot. Now, this is an area where you want to do your due diligence. And the due diligence that I recommend is when you want premises and the landlord says, give me a covenant, say no. And the landlord will say, well, then I won't rent the premises to your company. And say, okay, fine, I'll go somewhere else. And the landlord will go, oh, wait, okay. We'll deal with your corporation. And the reason they do that is there's generally more space available than there are businesses, right? And so the landlord would rather have a corporation on the contract and get some revenue and face the possibility that they may not be able to get paid completely, rather than have their premises empty. Now, there are areas in Vancouver where, like the Gastown and that area down there, there's more people that want to locate there than there are spaces available, and the landlord will say, we want a personal guarantee, which is called a covenant. It's the same thing, that you'll pay if your corporation can't. And if you want to be in that area, then you've got to give the landlord what he wants. But other areas of the city, for example, my Sylvan Learning Center client at one point had 4 locations, okay, and 4 leases with 4 different landlords. And every time the landlord said, okay, we will allow your corporation to become the lessee, but we want you, Pat, that's the owner's name, to give us a personal guarantee. And he said, no, sorry. And they said, oh, okay, fine. Now you have to be a little cautious here. This is free legal advice, and no, it isn't free legal advice because I'm not a lawyer. So this is just a free business advice. Well, I am a lawyer, but I'm not called to the bar. free business advice. Pat, when he went to the landlord, said, okay, my corporation will lease the premises, and they said, we want a covenant, and he said no, and they said, okay, no problem. And then they send the lease down to him, and there's a spot on the lease for the corporation to sign. The corporate name per authorized signatory, Pat's supposed to sign there. Right underneath that, there was another line with Pat's name under it and a red seal. And my client does his due diligence. He looked at this and he said, why am I signing twice? And he called me up. I said, send it down to me. I looked at it and I said, okay, Pat, the landlord is saying sign for the corporation. That's the first one, per. And then underneath, they're saying you're signing, covenanting that you will pay if the landlord doesn't. And he said, no, that wasn't the deal. I called it the landlord, and the explanation was, oh, really? My gosh. Okay, yeah, no, that's the agreement. No covenant. But, I gave the file to my, assistant who, gave it to a secretary who did up the lease. And, we usually do that. So there it was. And it's, just a mistake. I don't know whether it was a mistake or not. But had Pat signed both of those, and then 3 years down the road, there's some problem. Pat says, well, I signed for the corporation, but there was supposed to be no covenant. The judge would say, well, then why did you sign a covenant? and you cannot come back 3 years later and say, no, that signature is wrong. Okay, so I called up the landlord, and when he went through this dance routine, we just took a pen and scribbled over the personal covenant line and pat signed for the corporation. That happened in 3 out of the 4 leases. 3 different landlords either made a mistake, oh my gosh, or they were trying to pull a fast one. Okay, so you have to be really careful. That's when you want to make sure you do your due diligence, which is not only read the lease and make sure everything is copacetic, but make sure that you run it by your lawyer. Okay, so there are in effect 15 ways that you can be held personally liable and because the corporate veil can either be pierced or circumvented. That begs the question, if you incorporate a company because it gives you limited liability protection, why bother if there's all these ways that you can be held liable? So then what you have to do is you have to look at the lists and see which ones or which things are not there. Okay, and 2 things are not there, which still makes it extremely important to consider using the corporate form of business organization to limit liability. So let's look down the list. Oh, there are no torts there. Oh, there are no customer or supply contracts there. All right, what's that mean? You have a corporation like Peak Performance Pontoons, you've got 126 people pounding out skis. One of those is negligent, makes a mistake, a ski goes out, a person's injured. That person has a personal injury lawsuit for negligence against the corporation Peak Performance Pontoons, Inc., not against Benton Counter. Well, no, that's back up. That's not quite correct. The person has a personal injury suit for negligence against the employee because the employee had a duty of care, breached the duty of care, and caused the customer a damage. Now, that employee probably does not have enough money to compensate the injured customer. So, Peak Performance Pontoons, Inc. is vicariously liable for the tort committed by the employee. Benton Counter is not vicariously liable. Okay, only the corporation, because the corporation has the contract of employment with the employee. If Benton Counter was negligent in the hiring process, didn't check the references, something like that, then maybe he would be also negligent. Okay, but as long as you advertise correctly, have them fill out application forms, interview them, check their references, hire the best possible candidate, have orientation and training, and supervise them to the best of your ability, then Benton Counter or his operations manager, Gary Grimes, will have done their due diligence. Everybody makes mistakes. An employee makes a mistake, they're negligent, they owed a duty of care, breached the duty of care, caused the injury, they are liable, the company's vicariously liable, but not Benton Counter or Gary Grimes. All right? So there's all sorts of torts, right? Well, all those torts, and none of them are on the list. The tort is committed by an employee, the employee is liable, okay? The other thing that's not on another thing that is not on the list is the contract with a customer. Okay, so the company has a contract with a river rafting company and they buy 100 sets of skis, and it turns out there is a breach of contract, the skis are faulty, whatever. Okay, well, the river rafting company can sue Peak Performance Pontoons, but cannot pierce the corporate veil and sue Benton Counter or Gary Grimes or any other director and officer. Okay, suppliers. Peak Performance Pontoons makes fiberglass skis. They have to buy fiberglass. They have bindings. They have to buy the materials to make the bindings. They have gyroscopes. They have to buy the gyroscopes. So they get all this product, and for some reason they cannot pay they cannot pay the suppliers. The suppliers can sue Peak Performance Pontoons Inc., but not anyone behind the corporate veil. So those three scenarios, contracts with customers, contracts with suppliers, and tortious liability, are still very, very significant risks, and so you should consider using the corporate form of protection in order to get limited liability. All right? Okay. That's generally on the final exam, and we will have a practice problem where there's a business scenario and something goes south and the company goes into insolvency and people are owed money and the company can't pay, and so can you pierce the corporate veil? Who's liable and who isn't? All right, so but we'll come back to that. We'll work through it. There's a quote. Now, the very famous case with regard to corporations, which establishes this whole concept of limited liability, and the separate legal entity, was a famous case of Solomon versus Solomon and Co. And the House of Lords, when making the decision that the corporate form of business organization is separate from the owners, okay, was a landmark decision. Incredibly important case. It's discussed in the textbook, and you will have read it. What one of the House of Lords did, one of the judges did in the case, was explain this problem of the corporate veil, and that's why some judges over time have found reasons to pierce the corporate veil. But it's on slide 202, and I read it. Whatever may be the moral duty of a limited company and the shareholders, when the trade of the company is not thriving, the law does not lay any obligation upon them, in other words, the people running the business or the corporation, to warn those members of the public who deal with them on credit that they run the risk of not being paid. Okay, so that's suppliers and contracts with customers and things like that. Okay, and one judge in a similar case went on to say that a corporation does not have a soul. Okay, it is profit driven, and that's the bottom line. And what the judges over time have said is, okay, there are other things as important as profit in certain circumstances. All right. That concludes this chapter on corporations as far as the slides go. I do want to reiterate, though, that one of the things you should do if you have a corporation is to make sure that you have that shareholders agreement. All right? Because then it's one of the risk management tools that reduces the possibility of liability. And also you want to make sure that you use insurance, because insurance will not ever prevent a problem from occurring, but it will compensate the injured party and thereby shift the risk of loss from the corporation to the insurance company. That being said, that segues into the final chapter of the term, and that is the chapter that I call miscellany, because it covers not only insurance, but it covers intellectual property, and it covers the things that business people and everybody actually should do to make sure that they have their estate in order. So that will be the next video. Thank you very much.